There are two basic types of stock that a company can issue. These are called common stock and preferred stock. But there are some key differences between these two types of stock. Common stock is what most people think about when they think of equity. This is the unit of ownership in a corporation, and it represents the ultimate control of the company through its voting rights. Common stock is actually the lowest claim on the company's assets and earnings. It also has the greatest upside. As those earnings grow, the common stock becomes more valuable. Preferred stock, on the other hand, acts more like a fixed income security. It pays dividends at a specified rate. Preferred shareholders are entitled to receive dividends before the common holders. However, the preferred shareholders have no control over the company because they ordinarily have no voting rights. The upside of the preferred shares is generally limited to the specific dividends that they receive. Preferred shares do not appreciate as the company's earnings grow. It's important to understand a concept called the priority of claims. At the top are the creditors. These are the company's lenders, such as banks, bondholders, and suppliers. Beneath the creditors are the preferred shareholders. And finally, at the bottom are the common stockholders. The common stockholders take the greatest risk, but they have the greatest potential upside. If you want to learn more, you can visit our website at fundamentalinvestinginstitute.com, where we have additional educational resources.